So we covered two methods of depreciation, the straight line approach and the decline and balance method. We're now going to take another method, but before we go there, we'll look at partial year for the decline and balance method. So what if, again, we did not acquire the asset until the month of April? We know with a full year, the amount would have been $5,200. However, we only had the asset for 9/12 of a year. April through December represents 9 months. So the amount expensed in 2017 would have been $3,900. Now that would change all of our figures because now for 2018, you will have a new beginning book value. But notice that at the end of the first 3 months in 2022, the amount expense would be $180 because once again, the total amount expense, the $12,000 shown here, must be the same as the depreciable cost of the asset. Okay. The units of activity method is a system of depreciation that's based upon activity. It's not so much based upon time. With this approach, we figure out what would be our depreciation cost on a per unit basis. The unit could be miles driven, machine hours used, hours flown. It's going to be some type of measurement because we're dealing with a delivery truck. Our unit of activity is going to be miles. So we estimate this truck to be driven for a total of 100,000 miles. Our depreciable cost was $12,000. Therefore, our cost per mile driven is going to be 12 cents. With this approach, we're going to you'll be given the actual usage each year. So we're saying in this first year, we drove the truck 15,000 miles. So take the 15,000 miles times the cost per mile, which is 12 cents. The expense amount in the first year will be $1,800. So each year, they will give us the miles driven for each year. So 30,000 miles in year 2. Take your time 12 cents to get your expense. But again, you're still keeping track of how much we've expensed so far. This is showing the mileage in year 3. Again, you're keeping track of the current depreciation, the mileage and the expense in year 4. So right now we're at 10,800. So before I even show the numbers for year 5, let me ask you a question. How much are we able to expense in year 5? You're correct. The amount must equal $1,200 because at the end of the 5th year, the total amount appreciated must be the same as the depreciable base of the asset. Now, it just so happened we drove the truck 10,000 miles in 2021. But even if we drove the truck for 20,000 miles in 2021, the expense amount will still only equal $1,200 because this amount here cannot be more than the asset's depreciable cost. And again, the depreciable cost amount was $12,000. Regardless of the method chosen, the account types are the same. You always debit the expense for depreciation account and credit the contra account known as accumulated depreciation. Okay? It's just a timing issue. If you compare all 3 methods, you will see that over the 5-year period, with each of them, it expends a total of $12,000. It'll just be a different amount in those years depending upon the method that is chosen. As a company, you can choose any of these 3 methods to record your depreciation expense. Now remember that, go back, that was too quickly. Salvage value and useful life are estimated amounts. We don't really know how much we get for an asset at the end of its useful life. We don't really know how long an asset can be used to provide us with services. But we do our best estimates based upon historical information. But sometimes there's something causes us to revise our useful life estimates or salvage value. So when there's a revision, we do not change anything from previous years, but we're going to look at the revisions and it will affect the year of the revision and it will affect in the future years. For example, let's say we purchase equipment that costs $510,000. It had a useful life of 10 years with a salvage value of $10,000 at that time. Okay? Depreciation has been recorded for 7 years on a straight line basis. It says in 2017, which is year 8, it's determined that the total estimated life should be 15 years rather than 10 years. And the salvage value should be $5,000 rather than $10,000. So at the beginning of year 8 or in year 8, we're going to make revisions to the amount of our depreciation. Question 1 said, what is the correct entry to the prior depreciation? So before the changes are made, what would be the amount of the depreciation? So take your cost, 510, minus your salvage, 10,000. Depreciable cost will then be how much? $500,000. Divide that by the useful life of 10 years. And so previously we would have spent $50,000 per year. Now, because we made this revision, that doesn't require us to make a journal entry, but you do want to know how much of the cost we have depreciated so far. So to complete the expense for 2017, again, we look at the estimated cost minus salvage to get our depreciable base, divide that by 10 years. So we've expended so far $50,000 per year. We've had the asset for 7 years, so we expended so far a total of $350,000. So in your 2016 balance sheet, it shows the cost of the equipment, $510, less the accumulated I can't get the word out, less the accumulated depreciation, got it, for $350, and that would give us a net book value of $160 at the end of 2016. So the 2016 ending book value becomes the 2017 beginning book value. So for 2017, we take our net book value less our new salvage value of $5,000. So now our new depreciable base will be $155,000. Remember that they estimate the useful life to be a total of 15 years. Keyword being a total of 15 years. We've had the asset for 7 years already. Therefore, there's 8 years remaining on the asset's useful life. Take your depreciable base, the $155,000, divide that by the 8 years to get annual depreciation for the remaining 8 years of $19,375. So for the next 8 years, we'll make this adjusting entry at the end of each year to recognize the annual depreciation expense. So because we extend the asset's useful life, and we also reduce its salvage value, notice that the expense went from being $50,000 a year for those first 7 years to $19,375 a year for the next 8 years. And that's how you account for a revision for your depreciation. Impairment. What does the term impairment mean? If an asset has become impaired, it has suffered what's called a permanent decline in its fair value. We're saying, what's fair value? I'm glad you asked that question. Fair value says, if I had to acquire this asset right now today, what amount would I pay for it? That represents the fair value of the asset. Sometimes the fair value of an asset is going to decline. It goes down. So if by chance the book value of an asset, remember book value is original cost less current depreciation. If the book value of an asset is greater than the fair value of the asset has to be written down. That's because the asset is overstated in the accounting ledger. So once you want to write down the asset to show the lower of is book value or the asset's current fair value. I don't necessarily have a journal entry for this, but just understand what impairment means and understand from a conceptual standpoint, how do we handle an asset once it has become impaired? Okay, we're almost done. The next section focuses on the disposal of a planned asset. So we had the asset for 5 years, 7 years, however long. Now it's time to dispose of the asset. When it comes to dispose of an asset, typically it can be handled in 3 ways. We can retire the asset, meaning it'll be scrapped or discarded. We don't get much for the asset. Or it can be exchanged. You exchange your old car or trade it in when you purchase your new automobile. Or the asset can be sold. We're going to come back with our final video and focus on how to handle disposal of a planned asset. We'll mainly look at when the asset has been retired or if the asset has been sold. We talk about the exchanges in more detail for those who have to take intermediate accounting. So stay tuned for our conclusion of our Chapter 9 video lecture.